Hello everyone. Let's begin with the topic money and credit. In this chapter of economics, that is money and credit, you will learn modern forms of money and how they are linked with the banking system. In the second half of the chapter, you will know about the credit and how it impacts borrowers depending upon the situation. So, money as a medium of exchange. Money acts as an intermediate in the exchange process. It's called a medium of exchange. A person holding money can easily exchange it for any commodity or service that he or she might want. Like, for example, if I want maybe a pair of shoes or maybe a watch, then I can exchange those commodities with money. I can actually pay the shopkeeper the money, the amount which is equivalent to the worth of the product which I'm actually getting from that person, and then I can get those things. So, in that case, money is a medium of exchange. Now, what's the modern form of money? So, in early ages, Indians used what? Grains and cattle as money. Thereafter came the use of metallic coins like gold, silver, and copper coins. You must have studied these, right? A phase which continued well into the last century. Now, the modern forms of money include what? Your currency, paper notes, and coins. The modern form of money, that is currency and deposits, are closely linked to the working of the modern banking system. So let's study about currency and deposits in bank. Currency. In India, the Reserve Bank of India issues the currency notes on behalf of the central government. No other individual or organization is allowed to issue the currency. So only the Reserve Bank of India has that particular responsibility of issuing the currency notes on behalf of who? On behalf of the central government of India. The rupee is widely accepted as a medium of exchange in India. Now, the deposits in banks. The other form in which people hold money is as deposits with the banks. People deposit their extra cash with the banks by opening a bank account in their name, and bank accept the deposits and also pay an amount as interests on those deposits. So this is what currency and deposits in banks are. Now, the deposits which we do in the bank, they can be withdrawn on demand. So if I can withdraw them on demand, then they are known as what? Demand deposit. And the payment are made by what? Checks instead of your cash. Now, what's a check? A check is a paper instructing the bank to pay a specific amount of person's account to the person in whose name the check has been issued. You all must have seen a check. Like, for example, if I'm giving check to someone, then I am actually instructing the bank to take out that amount of money from my account and give that amount of money to that person. Alright, so this is what check is, and demand deposit is nothing but it's basically if the deposits from the bank accounts can be withdrawn on demand, then that is termed as what? Your demand deposits. Now let's study about the loan activities of the bank. How does the bank actually give you loans? So banks keep only a small proportion of their deposits as cash with themselves. These days, banks in India hold about 15% of their deposits as cash. This is kept as a provision to pay the depositors who might come to withdraw the money from the bank on any given day. Banks use a major portion of deposits to extend the loans. There is huge demand for loans for various economic activities. Now let's understand this. All right. Okay, let me give you an example and let's understand. So suppose this is a bank and this is a person who is person A and this is a person who is person C. Now suppose this person A has some amount of money and he or she wants to deposit it with bank. So this person A is going to deposit suppose X amount of money to the bank, and because he or she is actually depositing some amount of money to the bank, he or she will get some interest on that money. Okay, let's suppose that interest is what? M. Okay. And similarly, there is a person C, but this person C is actually in need of money. So he will take a loan from the bank And suppose he takes Y amount of loan, but the bank is going to charge N amount of interest to that person C. Now what the bank is going to do, the bank is going to actually charge a higher rate of interest from that person C than what the bank is actually providing to A. And the difference between the two is what? It's the income of the bank. So this is how the process of the bank is going on. Like a few people are coming to deposit their money, whereas a few are coming to take loans. So the bank is giving interest and the bank is taking interest as well. So the interest which the bank is taking is what? Higher than what it's providing to the people who are actually depositing some amount of money in the bank. So this is how the loan activities of the bank work. So bank charges a higher interest rate on loans than what they offer on deposits. This is exactly what I just explained right now. And the difference between what is charged from the borrowers and what is paid to the depositors is their main source of income for your banks. So this is what are the loan activities of the banks. Now, let's study about the credit situation and how it can be positive, whereas in the other situation it can be negative. So credit is nothing, it's just a loan, and it refers to an agreement in which the lender supplies the borrower some amount of money, goods or services in return for the promise of future payment. Now this loan, we obviously take loan from what? Either we take loan from the banks or we can take loan from like our friends or relatives or people to whom we trust. So let's understand how this credit situation can be positive and how it can be negative in few cases. So festive season. In this case, Saneem obtains credit to meet the working capital needs of production. The credit helps him to meet the ongoing expenses of production, complete production on time and thereby increase his earning. In this situation, credit helps to increase earning and therefore the person is better off than before. So this is exactly what? This is a positive situation in which the credit, or you can say the loan, is helping Salim to attain some kind of profit in his business or to actually make his business do good. Whereas let me tell you another problem, and that's Sapna's problem. Now in Sapna's case, there is failure of crop that made what? The loan repayment impossible. She had to sell part of the land to repay the loan. Credit, instead of helping her improve her earnings, left her worse off. This is an example of a debt trap. Credit in this case pushes the borrowers into a situation from which the recovery is very painful. So this is what? This is a debt trap. Now in Salim's case, we have seen that the loan actually, or you can say the credit actually helped him. Whereas in Sapna's case, I can see that the credit or the loan did not help her, but actually left her in much worse condition. So whether credit would be useful or not depends upon the risk in the situation and whether there is some support in case of your loss. Now in case of Sapna, there was no support, right? There was totally no support. So obviously she was left what? Worse off. Let's move forward and read about the terms of credit. So every loan agreement specifies an interest rate which the borrowers must pay to the lender along with the repayment of the principal. In addition, the lender also demands collateral, that is security against loans. Now the thing is, like for example, a bank is giving you a money. Like suppose you are actually buying a home and you need bank for your support so that you can make the payment with the help of the money that the bank is giving you. So now the bank is obviously thinking that you are going to pay the money in future. But what if you didn't? Then what is the bank going to do? To actually avoid that situation, there is a thing which is termed as collateral. So what it is actually is like, for example, if you are buying a house. So the documentation of the house, that is all the papers of the house, those papers are taken by the bank and they will be kept with the bank unless and until you repay all your loan. Okay, so that is termed as what? Your collateral. So let's see what the definition of collateral is. Collateral is an asset that the borrower owns, such as land, building, vehicle, livestock, deposits with the banks, and uses this as a guarantee to the lender until the loan is repaid. And in the example which I have given you, what was the guarantee? It was the documents of your house which you have just bought. If the borrower fails to repay the loan, the lender has actually the right to sell the asset, or you can say the collateral, to obtain the payment. Interest rate or collateral and documentation required and the mode of repayment together are called your what? Your terms of credit. It may vary depending on the nature of the lender and the borrower. So all these are what your terms of payment. So now we understand what the collateral is, we understand what the terms of your credit are. So credit in India. Now credit in India can be given in two ways. One is your formal sector and another one is your informal sector. So cheap and affordable credit is crucial for a country's development. The various types of loans can be grouped as your formal and informal. So what are the formal? These are the loans from banks and cooperatives. The Reserve Bank of India supervises the functioning of formal sources of loan. Banks have to submit information to RBI, that is the Reserve Bank of India, on how much they are lending to whom and at what interest rate, etc. So this is the formal sector loans. Whereas we have also studied about the informal sector loans. So what are the informal sector loans? These are the loans from the money lenders or traders or employees, relatives, friends, etc. There is no organization that supervises the credit activities of the lenders in the informal sector. There is no one to stop them from using unfair means to get their money back. Or I can actually say that the formal sector is like the organized sector and the informal is like the unorganized sector wala jo loans ka part hoga, which we take from friends or relatives or the people to whom we trust. But there is no, authority, a supreme authority which can regularize or actually keep, checks and balances that whether the person who has given the money or who is borrowing the money, are they functioning in a proper order or not. So there is nothing of that sort in your informal sector loans, but everything is maintained and everything is done in a very responsible manner in your formal sector loans. Let's move forward. So formal and informal credit. Now the formal sector means only about half of the total credit needs of the rural people. So it's astonishing that the formal sector only needs half of the total credit needs of the rural people. The remaining credit needs come from what? The informal sources like your friends, your relatives, people whom you trust, your neighbors, etc. It is important that the formal credit is distributed more equally so that the poor can benefit from the cheaper loans. It's necessary that banks and cooperatives increase their lending, particularly in rural areas, so that dependence on informal sources of credit reduces. While the formal sector loans need to expand, it's also necessary that everyone receives these loans. So we just do not want to expand it. We also want that everyone is getting benefit out of it in the rural area. Alright, we just do not want to expand the production and the services. We also want the people to utilize those services which are provided in the formal credit sector. So there is one very important thing, that is self-help groups for the poor. So what actually are your self-help groups? Poor households are still dependent on what? The informal sector of credit. Because of what reasons? Firstly, banks are not present everywhere in rural India. And secondly, even if banks are present, getting a loan from a bank is difficult because they require proper documentation and collateral. So that is why taking loan from banks is very, very difficult. So to overcome these problems, people have created what? They have created your self-help groups, that is called your what? SHGs. Now SHG are a small group of poor people which promote what? They promote small savings among their members. A typical SHG has 15 to 20 members, usually belonging to one neighborhood, who meet and save regularly. So what the self-help groups are going to do? They are like a team of 15 to 20 members who collectively save, and then they can deposit, like open up a bank account, and then they can have loans. So it's like a community kind of a thing. So that is what your self-help groups or SHG actually is. But what are the advantages of your self-help groups or SHGs? So the advantages of self-help groups are, it helps borrowers to overcome the problem of lack of collateral because there are 15 to 20 members, right? Then people can get timely loans for variety of purposes and at a reasonable interest rate. SHGs are the building blocks of organizations of rural poor. It helps women to become financially self-reliant because when 15 to 20 people are going to meet, they are also going to discuss various issues. All right, and suppose there is a self-help group of women, so they are going to come together and they are going to discuss their problems, and also they help women to become what, financially self-reliant. The regular meetings of the group provide a platform to discuss and act on variety of social issues such as your health, nutrition, domestic violence, etc. So I hope you understood what self-help groups are, and I hope you understood what the chapter of money and credit is. You can go to EduRev's site and view all the documents. You can just give some tests and revise this chapter altogether. Thank you so much.